Okay, welcome back. 120 points higher is what you have. 22,768 is where we stand. Coforge, of course, is the stock of the day, one of the stocks of the day. But, of course, it's down on the downside, 7.5% lower. Weak fourth quarter earnings, margins have contracted, revenues, though, are in line with estimates. The company will also be picking up a 54% stake in Cigniti Technology. Sudhir Singh is CEO at Coforge. He's joining us now to take some questions. Mr. Singh, good morning. Good to have you with us here. Thank you very much for your time. Prashant, this side. You know, Mr. Singh, the thing which many are pointing out, many analysts are pointing out, is the lack of a guidance, sir. You typically put out a full year annual guidance, which you've not done this time around. How should one read that? Is that sort of the lack of clarity in terms of how the business is proceeding, demand uncertainty?
I think one should interpret that as a very strong conviction that the last 7-year growth performance of the firm is going to sustain and very robust growth is going to come in. What we've done this time is we've pointed to the fact that over the last 7 years, we are a firm that has every quarter for 7 years called out our order executable, which is the next 12-month signed order book, every quarter, not just at the beginning of a year. And that's had a very strong correlation with the actual revenue that we deliver. This year, let's start with FY24. We started the year with order executable 20.7% higher YOY, and the firm clocked 13.3% revenue. What we've called out very clearly is we're starting this year with order executable 17.3% higher, and we expect the correlation as it has for the last 7 years to continue. So on the revenue side, we're trying to offer a pointer to a metric that we update every quarter, which we believe is going to be a better surrogate than just an annual guidance. That's point number one. Point number two is we have given a very hard guidance for margins, where we've said that we expect our margins to expand by 50 bips. And point number three, we've again given a very hard guidance around revenue by FY27, where we've said Coforge that closed this year at $1.11 odd billion will be a $2 billion firm at the end of FY27, operating at margins that will be 150 to 250 bips higher than the number that we realized in FY24. So that's how we see the margins, and that's how we see the year that's coming ahead of us, with significant confidence in the fact that growth, and this is organic growth, will be robust.
Yeah. No, I mean, that's great that you're putting out a bigger kind of a vision and numbers for FY27, and we hear that. So then, I mean, it should not be a problem for you to sort of put down a number for 25 constant currency growth as well, right? So at least 13%, we can take that from you for 25?
I can just offer you what I just did. And the maths is, I suspect, fairly simple. 20.7 resulted in a 13.3% growth.
Yes.
We're entering this year with a record quarter 4. We're entering this year with 17.3% order executable. And we believe growth is going to be robust going forward.
All right. So Sudhir, just doing that math itself, when the order executable growth was 20%, you've delivered around 13.5% approximately. If I put in the same matrix, 17% should result in a 10 to 11% growth. Would that be fair?
Broadly fair.
Correct. Yeah, because the number that you're giving us itself is that 0.65 in terms of a ratio. So I think 10 to 11% should be fair, and I think you're mostly on board on that. Give us a few more details then. Are you being very aggressive on winning new contracts? Because there is some signs of pricing pressure, right? Give us your take on that.
Why don't I step back for a minute and quickly reflect on the year before I talk about pricing pressures. We've closed the year at 13.3% organic CC growth. And I want to underline it. This is all organic. This is CC growth. We're possibly the only firm that started FY24 with a hard annual guidance, and the only firm that's delivered on that guidance, right? So I think it's important for us to know that. As far as margins are concerned, we were again possibly the only firm that gave 100% salary increments to all its employees on the 1st of April of 2023, something that we will do again this year. So our margin numbers that have come in FY24 came in without trying to effect cost outs at the expense of our employees. And the only change that you see in margin in FY24 over FY23 can straight away be pointed back to the increase in the sales, solutioning, and the pre-sales cost that the firm has increased, which has been parked under the SG&A numbers for our organization. We feel confident about margins. We know exactly where the margins have come in and why, and that's why we've given a very firm guidance for margin for next year as well.
Okay. Sudhir, hi, good morning. I want to talk a little more about the acquisition, right? While it does help you scale up in retail high-tech, the view in the market is that it's not a company with capabilities in this new age tech domain. How would you want to counter that argument?
We would counter it by first reflecting on the fact that we possibly know more about the firm than most analysts in the market would, because we've spent months now working not just through their marketing promotional material, but working with the CEO -1, all the way up to CEO -3. There are three things that Cigniti brings which makes it a game changer, and I say this very consciously, a game changer acquisition for Coforge. Number one, it's not just the two verticals you talked about. 3 new verticals are going to get created. Retail will immediately start operating as a new vertical for Coforge at almost $100 million USD per annum. Healthcare and high-tech that we've talked about for the last 2 years, the merged entity, those verticals are going to be operating at $50 million USD approximately. So number one, 3 new verticals will get formed. Number two, Coforge has been a very East Coast, North America-centric organization in terms of our client presence. Cigniti is a very West, Southwest, and Midwest-focused organization. So number two, our revenues in North America, a geography that we've repeatedly called out as a geography that we want to expand in, will jump day one post-merger by 33% in the sub-areas where we've not been present. Number three, to your immediate point around assurance services or testing services. See, all of us recognize, and this is something we worked over the past few months, AI is going to spread, AI has proliferated, and the expansion of AI is going to mean that the complexity and therefore the opportunity around assurance services will expand in specific areas. Those specific areas are the non-functional testing areas. We work with airlines. We know that every airline that we're working with is looking at possibly an AI engine to help them with revenue optimization. Imagine a scenario where an airline were to put in an AI engine and there was an issue with the algorithm. Functional testing is not going to work in the context of AI-enabled organizations. That's where Cigniti comes in. That's what we've been working with them around, right? Performance testing, security testing, automation testing is where they come in.
Correct. Got that. Qualitatively, I get your point. But quantitatively, can you tell us, I think annual revenues are somewhere around $220 million currently. What will it bring to the table in terms of revenues for your consolidated entity once it comes on board in its entirety? And what kind of sustainable growth rate do you see for Cigniti?
Oh, we see growth at Cigniti at least on par with the organic growth that we see for ourselves. And I've called out very explicitly the fact that our guidance is that our organic growth is going to be robust. And it's going to be in line with the metrics we were talking about earlier. We don't expect Cigniti to be a drag on revenue growth. We think Cigniti so far has the 28-odd Fortune 500 clients where they've fundamentally only been selling assurance services and digital engineering. We are going to go to the same clients, and we will sell the 9 other technology service lines that we have. So we expect Cigniti, at worst, to be growing at the same rate as Coforge, and at best, to be leading it.
All right, Sudhir, a couple of more details then. You briefly mentioned that this acquisition will help you all scale up the US presence. I think North America currently forms around 48% of the mix. Where is it headed from there? Point number one. And also, you're planning a QIP, right? What is the quantum and time frame for it? You've already got the board approval.
First question, 48 is going to move to 55% immediately.
Got it.
Second
right.
question, as far as the QIP is concerned, so 48 goes to 55, point 1. Point 2, QIP is likely to be of the order of about $250 million. That will allow us to take 51 to 54% stake. Post that, step 2 is going to be a share swap to complete and to consummate the complete merger.
Okay, got it. So, you know, you told us about the acquisition, right? I think what you're trying to do is with these acquisitions, scale up your US presence, whether it's North America or some other geographies. Now, North America currently forms about 48% of your revenues. With these acquisitions coming on board, how much can you take it up to from that geography?
Day one, as I said, 48 is going to become 55%. And that's a big blip for a firm our size.
Okay, all right. Just to clear this point, 250 million will be raised to get through the first part of it. And is there a share swap as well that you were mentioning?
That's right. We're not going to stop at, you're right, 51 to 54% only. The rest is going to be effected through a share swap. The merger.
And what dilution would that? What dilution would that be?
That would be depending on the market price at that point in time, I guess. That's what's going to determine the swap ratio.
All right, we'll leave it at that. Sudhir, thanks a lot for joining in. Appreciate your time here on CNBC TV 18. Well, let's